Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets.
I'm Joann Spadigam, European rate strategist, and I'm joined today by our global market specialists, Kevin Cummins, Stuart Sparks, and Paul Robson. So it seems like this week we're back to regular programming to some extent, but of course it's been a big shift in geopolitics in the last week. So I think it's probably worth just going back on that, highlighting where we think we are now. So the US, of course, intervened over the last weekend with strikes in Iran. And since there's been a ceasefire called by Donald Trump. So, Stuart, let's go to you first. Do you think this is the end of the war? How are you thinking about tail risks at this point?
I don't know if it's the end of the conflict or not, but I think that the market reaction to escalation since October 7th in the region have been both short-lived and very muted, and in this case, indeed. I think that this reflects both the tactical realities with respect to the combat theater and also the lack of interest of the more major global powers, the U.S., China, maybe Russia, in seeing it escalate. So our sense is that we're sort of back to normal business, if you will.
And Paul, how are you seeing the market reaction following the ceasefire?
Well, I thought that Stuart described it very well. I mean, it was quite remarkable, wasn't it? We went from peak escalation to what seems to be peak de-escalation, and at the end, perhaps there were no good choices for various parties, and we got that de-escalation. For markets, it was always about the oil price. Obviously, no one really knows for sure how this will play out. And I think it's just the law of unintended consequences. Once the US got involved, you open up a whole wide range of distribution of possible outcomes, and you're sort of back to all the way from known knowns to unknown unknowns, and we'll just have to wait and see how that plays out. But markets have taken it as a positive. For me, it feels very much like a movie thriller where you get a late twist. I think that's what markets just need to guard against. Don't want to be too complacent. Something like, well, one of my favourite films, actually, Layer Cake. I don't want to spoil it for people who haven't seen it, but you get twists and turns in that particular movie, and so it might come to pass in terms of the Middle East. For what I thought was really interesting, though, in terms of market reaction, was how investors seem to want to play it or position or protect their positions via currencies rather than equities and fixed income. The sort of moves in bonds particularly was actually relatively muted, as Stuart quite rightly said. And I think that's because people are more confident about how moves in the oil price through inflation and growth hit individual currencies. The correlations are more established. I mean, the three of us and four of us, including Kevin, have discussed how the impact on bonds is a little bit more nuanced in terms of the impact of growth, inflation, and central bank reaction functions. More uncertainty about that. And so the biggest market move, I think, came with the dollar retracing earlier strength, although that also came at a time when we obviously had Fed speakers and Powell's testimony as well. So trying to unpick that was a little bit difficult.
Yeah, and I mean, I think just going on that market reaction point, Paul, the improvement we've seen in risk sentiment and the compression we've seen in BTP spreads this week has been pretty significant. On the day after the escalation, or de-escalation rather, BTP spreads had tightened down by 5 basis points. So I think, to me, the market is essentially going back to normal to some extent following the spike in risk appetite. And I think for us, our structural view that BTP should continue to compress does continue to hold. And again, we talked about that at last week's podcast. But interestingly, I think on the front side of things, political risks continue to linger. And pension reform was mentioned this week, of course, which might cause a motion of censure. But I think our base case still remains that BTPs and OATs will compress to zero. But the post-summer period and the budget negotiations really remain quite important in this regard. So I suppose moving back to what markets are usually bothered about, which is Fed and central bank speaking in general, there's been a growing contingent in the Fed that are supporting a July cut. Kevin, what did you hear from the semi-annual testimony, and has Powell weighed in on this very much?
Yeah, thanks for that. Obviously last week, shortly after the FOMC meeting, which by the way was they obviously kept rates steady and signaled what they had as of March when the dot plot showed two cuts for later this year. They didn't change that forecast, but there was a pretty wide variety of estimates that signaled really that left optionality on the table for the Fed, that they can not cut rates at all, cut by one cut or cut by two cuts. So they really left themselves time to see how things evolve. There are 19 members of the FOMC, and they're not necessarily all in lockstep with one another. That's always the case. But we did hear from Fed Governor Waller on Friday. He gave a television interview, and it basically opened the door to a possible July rate cut from his perspective. And then on Monday, Fed Governor Bowman, who previously was a hawk, delivered a very dovish speech by all accounts, and said that she could support a cut as early as July in order to bring rates closer to neutral to sustain. She was talking about a healthier labor market. Now, both of these members of the committee were appointed by the president. So I think that they're a bit of an outlier relative to the the rest of the committee, in that the message, I think, and we heard it from Powell yesterday, was kind of a wait and see how the course of the economy is going to be performed before considering any sort of adjustments to policy. So I think they're more of an outlier in that they potentially want to advocate for cuts as early as July if the data support that. Whereas I think the rest of the committee, it's going to take some time over the summer to see how things evolve with regard to tariffs and its implications for inflation. And I think that, that message was pretty clear in Powell's press conference last week, and we heard more of it yesterday. So he was specifically asked about July, and he avoided, commenting on other participants' views, but said that, right now he thinks that he's going to learn a lot over the summer with regard to tariffs and the possible upside risk to inflation, and the overall economy before they feel the need that they have to act. So I think it's very much consistent with the idea of a wait and see Fed. Our own forecast hasn't changed. We still are a bit out of the consensus where we think that the Fed is going to remain on hold. So we don't have no cuts this year. In fact, we don't have any cuts in our forecast horizon. We just think that Powell's term is ending in May of next year, and we're not going to see any sort of action before that, because in our forecast for inflation, we have it going further away from the Fed's 2% objective through the rest of his term. So it all come down to the data. It'll be data dependent, and as of now, it still seems like there's more upside risk to inflation than what we've seen slowing here in the overall economy so far.
So, Stuart, coming to you quickly just now, you do like curves flatteners, which is a bit off consensus. How do you see that playing forward?
Yeah, I think on the margin, the data has been supportive for our view. We've talked and written a lot about this and noted that the equity risk premium is very tight, but the term premium, or the level of real yields at the longer end of the curve is quite high. I think that discrepancy represents value for a very important cohort of investors in the U.S. rates market, and that is the state and local public sector defined benefit sector. They have $9 trillion of pension liabilities. They're underfunded by about $3 trillion, and their asset mix is very heavily tilted towards risk. harvesting equity gains on the margin and reinvesting, de-risking into fixed income. And indeed, we can see that this has been happening over recent quarters. They've been better buyers of fixed income. And notably, last week, we got a data point, which was the change in the outstanding stock of treasuries held in strip form, which went up by about 11 billion, which is large relative to the historical distribution. And it suggests that there has been stripping activity to produce long principal strips for long-end ALM investors, such as these public pensions. So on the margin, we still have the Fed view, as Kevin has presented very well. And at the long view, we see the potential for a positive demand shock, which would render the twist, which has been the focus of our forecast.
Great, thanks. And just rounding off the central banks speak with the UK poll, we've had lots of Bank of England speakers as well this week. How did your comments square with last week's policy decision?
Yeah, it sounded like we learnt more about the Fed outlook than we did about the Bank of England outlook, despite a host of Bank of England speakers this week. I don't think we heard a lot that we didn't already know. Certainly, front end pricing didn't shift, and that normally tells you that there wasn't a lot new. Bailey continued to talk about how domestic events were more important than international events. Maybe he was relating to the oil price. He also talked about gradual and careful monetary policy, and that rates were on a downward path. I think that was been pretty clear from recent guidance and interest rate decisions here in the UK. Green, who we also heard from, who has tended to be more hawkish. She sounded a little bit more dovish on growth and employment, perhaps after the recent weak data in both GDP and payroll employment. But she was also cautious on inflation. And I think people have to remember that the number one mandate, only mandate of the Bank of England is price stability, and inflation continues to be sticky and uncomfortably above the inflation target. So I think that the Bank of England continues to cut cautiously. I think that was clear from the guidance, but that's what front end rates have got priced. They've got 21 basis points of easing at the August meeting, 53 by the end of the year. That's in line with our thinking in terms of 2/4 point base rate cuts. Terminal at 350 market pricing. Maybe that's a little bit dovish, but let's wait and see. If the deterioration in the data, certainly the labour market data that we saw last month, if that was to persist, then would it be downside for the policy rate? For me, the labour market data on July 17th, I just think that's going to be crucial for UK assets, both front-end pricing, the currency and long-end pricing. I think we'll watch that data to see the extent to which labour market data continue to weaken. And over the last couple of weeks, I've been out on the road seeing a whole range of corporate customers and industry, and I think it is clear that employment here in the UK is very weak. Inflation is sticky, and companies are trying to cut costs. So we'll just be watching the data very carefully. Just on a side point, I think the actual takeaway from the various speakers was more about the decision the Bank of England has to take on quantitative tightening come September. I've actually run out of fingers to count the number of speeches we've had recently on the topic. And here it definitely feels like that's going to be a focus through the summer. It's going to be important for gilts in terms of the amount of active sales. I think the various features do shift the needle a little bit more in favour of just a natural run off the balance sheet rather than proactive sales. But I think for the Bank of England, they said in the past that running down the balance sheet is independent of fiscal policy and monetary policy in terms of getting inflation down. And if they shift now, it would make it more obvious that it was a fiscal decision. And I think they might want to avoid that. So they continue with active sales. They want to get the interest rate sensitivity of the balance sheet down. And that requires reserves continue to fall. Reserves are still quite high, and they want to use the repo. So I think it was more the developments on quantitative tightening rather than the short-term policy rate outlook was the key takeaway for me this week. But elsewhere in Europe, Joanne, certainly in Germany, it looks like the focus was on the finance plan. I was just wondering what your key takeaways were from what you heard this week.
So lots of focus on the finance plan, as you said. We had a pretty significant bear steepening on the news, and I think that there's a couple of interesting points here that drove the markets. So firstly, at the top of it, the increase in funding has been for 15 billion extra in bonds and 4 billion in bills. And I think overall there was some expectation that we would see an increase in funding, which did come through. But a couple of things I suppose were surprising. So firstly, I think the Q4 numbers will also be revised upwards, and that was well telegraphed by the finance agency yesterday on Tuesday. And secondly, I think there was also this headline suggesting that perhaps the German finance agency could consider doing a 50-year syndication. I think both of these things were probably surprising, and the long ends did get quite hit on the headlines. I think for me, the 50-year syndication seems pretty unlikely. The demand supply imbalance is clearly shifting in Europe. We've talked about this before, but Dutch pension funds, who have historically been big buyers in the long end, are essentially no longer going to be supporting. So I do think a 50-year syndication, given the demand backdrop, does seem quite unlikely to me. But I think even so, the key takeaway really is that supply risk to the upside, that Q4 supply could be high, and that over the protracted period of time and the number of years going forward, supply will be on an upwards trajectory. And I think curve steepeners are a go with.
Yeah, it does seem to be that we talk an awful lot about supply, don't we, in the UK and Germany, supply everywhere. And it will be certainly interesting to see where the demand comes from that and the clearing price in various European bond markets. But looking a little bit further afield, what are your thoughts for next year?
So I think for next year, there's clearly going to be upside risk to supply, but I think also for Q4, we've essentially put in our number at 10 billion increase in issuance for Q4, and then I think significant issuance, of course, for the months and years to come. I think a couple of interesting points to note in terms of how they will issue and what that plan is. I think to me, the finance agency wants to maintain that resilient, safe haven status. They want to be seen as a DMO that is consistent. So I think that they'll take an approach that's pretty standard when it comes to issuance. So I'm not really expecting the weighted average maturity to change too much. I think they will be very predictable in their approach and will flag increases in spending quite early on if they can. I think that's what we will see in Q4 as well, with them essentially pre-notifying us that there will be an increase in Q4. They've not said volumes, but they have said that the share of bills and bonds that we will see in Q4 will be quite similar to what we had this time around. So around a quarter to a third in bills and the rest in bonds. But I think more interestingly, what we did learn this week was that even though they have increased their financing needs to 81 billion from 51 billion, there is still a funding gap, and they're essentially using flexible instruments to fill that hole. And as many people listening will know, the German Finance Agency does tend to make pretty good use of flexible instruments. So that's repo, retained bonds, treasury bills, and they'll be using that essentially to plug the gap. So for this year, that seems to be a approach that will work. But I do wonder if that may not be the strategy they use going forward, which again puts upside supply risks in Germany once again. I think the last thing to note will just be the 5% NATO target has been announced, and of course that's been talked about quite a lot. So I wouldn't say new news there particularly, but I think clearly there's a push for more defence spending more generally, which helps our upside supply risks narrative as well. I think that the political will for all countries in Europe to follow through is obviously quite low. Spain has already pushed back on that, and thinking about the EMU 10, only 4 out of the 10 meet the 2% target now. So I do think that a lot of this, in my mind at least, is going to be Germany pulling through for the euro area and German supply doing the hard work. So I think the supply risks for Germany, again, are really on the upside, and curve steepening is a go with once again. But that's it for me, and that's it from us for this week. Thank you to our listeners for listening. If you did enjoy this week's episode, don't forget to like and follow.